Welcome to The Explainer. Today, we're diving straight into a wild market anomaly, the explosive rally of the Make Aliens Great Again token. We're going to objectively unpack exactly what happened here and, more importantly, use it to understand one of the most dangerous traps in trading. The story begins with a staggering 253% price surge. And get this, it wasn't just isolated to a single exchange. We are talking about massive, uniform gains across 50-plus trading pairs in a mere 24 hours. This lightning-fast wave of momentum pushed the token's market cap to nearly $16.9 million. It literally left everyone in the market scratching their heads, asking how and why did this happen so fast? To make sense of all this, here is our agenda. First, the alien meme surge. Second, beyond the meme, the roadmap. Third, price predictions and technicals. Fourth, the dead cat bounce. And finally, spotting the fake-out. All right, Section 1, the alien meme surge, catalysts and market attention. So, impartially speaking, this token rode a massive wave of hype, sparked by an airport rebranding announcement from Trump. He unveiled a proposed logo featuring DJT call letters, and boom, that acted as the primary catalyst. It really highlights a fascinating market dynamic, doesn't it? Real-world political branding events can immediately trigger speculative crypto capital, completely regardless of what the token actually does at that exact moment. Moving right along to Section 2, beyond the meme, the roadmap. Now, what's genuinely fascinating about this project is its claim to be building utility way beyond the initial meme hype. Their development roadmap outlines 4 key milestones to transition into an actual information hub. They plan to start with an ecosystem NFT launch, then pivot to an advanced live UFO scanner, aggregate declassified government files into an expanded disclosure database, and finally, secure crypto exchange listings to bring in broader liquidity. I mean, you got to admit, transitioning from a meme token to a global UAP monitoring hub is quite the ambitious leap. Let's get into Section 3, price predictions and technicals. The absolute crucial point here is figuring out if this ambitious roadmap actually translates into sustainable price action, or if the technical data tells a completely different story. Right now, we're seeing a really stark divide. On one hand, you have this intensely bullish community sentiment, with influencers predicting a massive $50 to $100 million market cap breakout. But on the flip side, looking at the bearish on-chain reality, blockchain watchdogs are flagging highly concentrated insider ownership. And you know what that means? It carries a severe volatility risk and the constant threat of a massive, sudden sell-off. Let's look at the algorithmic forecast spanning from 2026 through 2028. The data strongly suggests heavy, ongoing volatility. The predictions are frequently bouncing between minimums of around 0.8 cents and maximums capping near 1.8 cents across multiple years. Basically, it paints a picture of an asset that's going to experience wild, aggressive swings. For your average retail trader, navigating this level of unpredictable chop is incredibly dangerous. And despite that massive 253% pump we just talked about, current technical indicators on TradingView are actually flashing an overall rating of strong sell. Moving averages and momentum metrics lean heavily bearish right now, showing 6 sell signals against only 3 buy signals. It's a stark reminder that sudden price spikes absolutely do not automatically erase bearish technical setups. Which brings us to our absolute biggest red flag. The token's trading volume sits at an unusually high 34% of its market cap. To put that into perspective, a healthy, sustainable market typically sits around a 10 to 15% threshold. So a 34% ratio, that is an extreme anomaly. It heavily suggests this price action is being driven by algorithmic trading bots, highly coordinated accumulation, or just pure emotional retail frenzy. And that underlying frenzy sets the stage for something far more treacherous. This perfectly sets up Section 4, the dead cat bounce anatomy of a trap. For those who might not be familiar with the term, a dead cat bounce is a short-lived recovery rally that pops up during a broader downtrend. It completely lacks the real volume and fundamental strength needed to sustain itself. These deceptive rallies are often fueled by short sellers buying back assets to secure profits, or emotional retail traders rushing in with a buy-the-dip mentality. But ultimately, the rally quickly fails and is followed by an even deeper decline. Let's break down exactly how this trap is set across 4 distinct stages. First, you have the initial crash, a sharp, high-volume sell-off. Second, a deceptive relief rally begins, entirely tricking eager buyers into thinking the bottom is finally in. Third, the price hits a lower high, meaning it stalls out at a resistance wall before it can reach its previous peak. And finally, the continuation. This is where the price just plummets right past the original crash level, trapping all those new buyers who thought they were safely buying the dip. Now for Section 5, spotting the fake out. To actively protect your portfolio from these bull traps, you've got to watch for these 4 structural red flags. First, look for declining volume during a rally. If the price is going up but fewer people are actually trading it, that's a huge warning sign. Second, watch out for the price hitting a Fibonacci wall, essentially a historical mathematical price point where assets face heavy selling pressure and stalling out. Third, look for bearish candle rejections at the peak. And fourth, watch for an RSI bearish divergence. This happens when the price is rising, but the relative strength index, your momentum gauge, is actually falling, proving the rally is basically running on fumes. Remember, knowing what a true reversal looks like is absolutely your best defense here. A true trend reversal requires strong, increasing volume and a tangible, positive fundamental shift, which forms higher highs on the chart. A dead cat bounce, on the other hand, merely pauses the selling pressure without changing that overall negative structure. It just forms lower highs on really low volume. The main takeaway here is that if you're considering exposure to highly volatile anomalies like this token, conservative risk management is absolutely critical. Position sizing should absolutely not exceed 1 to 2% of your overall speculative portfolio. And strict stop-loss protocols, those are essential to protect your capital from those violent downward continuation patterns we just talked about. So we're going to leave you with this final provocative thought to consider the next time a meme token inexplicably skyrockets hundreds of percent overnight. Ask yourself, can this token's underlying ecosystem actually sustain long-term momentum? Or are enthusiastic retail traders simply serving as exit liquidity for insiders in a classic dead cat bounce? Thanks for tuning into this explainer. Keep an eye on those charts, and we'll see you next time.